Welcome to NDR Signal Exchange, your go-to source for insights on the markets and the economy. In under 5 minutes, we'll answer your top questions and cover key trends shaping financial markets. I'm Brian Sanborn, NDR's COO and Global Head of Investment Solutions, and I'll be addressing a key question often asked by clients. How can I be more nimble with asset allocation? At NDR, we use an objective 360-degree approach, which takes a holistic view of the markets by measuring how markets should be acting through macroeconomic and fundamental data with how markets actually are behaving through technical and sentiment indicators. One of the top clicked pieces of content in the NDR library is our ETF Asset Allocation Model. This model allocates across and within stocks, bonds, and cash based on the weight of the evidence. One of NDR's key rules is to not fight the tape. Following the trend is important as it can help to keep you on the right side of major market moves. The trend also can reduce behavioral biases. Ned Davis has said that following the trend is important because the degree of unprofitable anxiety in an investor's life corresponds directly to the amount of time one spends dwelling on how an investment should be acting rather than the way it actually is acting. As a result, this indicator receives double weighting relative to the other indicators. It is important to measure the underlying health of the trend. To do that, we monitor the number of markets participating on the upside, which is called market breadth. Elevated breadth is important because if many markets rally, even if a few run into a trouble, enough markets remain in uptrends that can support the popular averages. Turning our attention to the bond market, we gauge the risk appetite of fixed income investors through the lens of high-yield option-adjusted spreads. When spreads narrow, fixed income investors have a more positive outlook, which favors more risk-taking. But when spreads widen, there is increased concern over the economy, which tends to be more risk-off. It is important to evaluate the overall health and direction of the economy for understanding both investment risks and opportunities, as well as putting clients on the right side of the major trends. To accomplish this, we examine the acceleration of the OECD Composite Leading Indicator, which is designed to capture turning points in the growth cycle. Improvement in global economic momentum is usually bullish for equities. Just as we measure the health of the market's trend based on participation, we can measure the health of the economic trend through breadth. The Purchasing Managers Index is based on a survey sent to executives regarding their outlook on areas such as inventories, production, and employment. When more economies have a positive outlook, that is typically bullish for equities. Finally, to keep our fingers on the pulse of the economy during the month, we examine global shipping activity. The Baltic Dry Index measures the cost of chartering freighters on key global cargo routes, which can be used as a proxy for global economic activity. A positive trend in the BDI can imply economic strength, which is usually bullish for equities. Putting it all together, when the indicators are bullish, the model can take a higher allocation to equities. When the indicators are bearish, the model can allocate more to fixed income. When the indicators are mixed, there is less conviction, which can lead to allocations near benchmark weighting. If you have any questions or would like deeper analysis, please submit your questions for the next episode by emailing neddavisresearch@ndr.com. Thanks for watching NDR Signal Exchange and letting NDR help you to see the signals.